Good day, class, and welcome to another interesting class of commerce. I welcome you all. Hope you are staying safe. Thank you. In our previous class, we started the topic profit. And I took time to explain extensively the different views of people about profit. We look at it as the financial gains that accrue to a businessman, the amount a businessman or a business person gets from his business as gain. You don't want to talk about business, you talk about gain or loss. So nobody wants to make loss, but at least we talk about profit more. But there is always the other side, which no business person or business owner prayed for or is ever praying for. So the purpose of being in business is to make profit. That's why we talk about it in most of the time. And we look at the view of the accountant. Say the accountant, their own view is that capital is the excess of income over expenditure. You understand? That is, the income must be more than the expenditure. And how do we measure it? We measure it by finding the difference. We establish also that their own view is quite different from that of economists. Accountants have what we call gross profit. They also have what we call net profit. The two of them, they are different. But before we talk about that, I first of all explain the view of the economist. That economists, they see capital, they see profit as the reward that an entrepreneur receive, the reward that an entrepreneur receive as a factor of production. And who is an entrepreneur? The business owner. The amount that comes to him, that comes to the business owner, at least as gain, irrespective of whether he's taking it from more expenses that is more income that is over, that is more than the expenditure or whatever. As long as it is gain, it is just what they take as profit. You get it. So we look at the layman, that how will a layman, a person who does not even talk, who is not an accountant, who is not an economist, how the person will define profit. And we said that in the view of a layman, profit is the excess of income by the expenditure of a business. And we established that quite well, that their view, or the view of a layman, is closer or much more closer to that of an accountant. So I hope you have downloaded your notes in the resource, in the Prodigy resources. Please try and do that and copy the note in your and copy the slide, everything in your note is for your good. Please. We have a gross profit. Excuse me. That's the types of profit we have, and I think I explained that your gross profit is the excess of your turnover over your cost of goods sales or goods sold. What do we mean by turnover? We mean sales, revenue. That's what we call sales in our business. So the gross profit is simply the difference between our sales and our cost of goods sold. And before we can even determine our sales, sometimes it has to be a kind of net sales. Why do we call it net sales? As we're going to see in this in an example very shortly, sales, we have to less our return inward. Return inward. We have to less it. You understand? And doing that, we call it accrual. One of the concepts in accounting. We have to less it from sales. We have to less our return outward from our purchases. You understand? So that's a kind of concept, a matching concept in accounting. I believe maybe when you must have done accounting concept and convention. Accounting concept and convention, these are all things that accountants go with. There is a set of principles that we go with that is just obvious in what we do. You understand? So the expenses of a period and the income realized through it, we have to do what? We have to make sure everything goes with one another. You understand? So how do we get our gross profit? Gross profit equals to sales minus cost of goods sold. Sales minus cost of goods sold. And how do we determine our cost of goods sold? That's opening stock plus purchases minus closing stock. I'm going to demonstrate that as we continue. So I think I explained that gross profit is just not the true profit. It's just the profit we realize on the sales made or the profit we realize on the production of the goods. You understand? And that involve the inventory and the purchases, the opening purchases, the opening inventory, the additional the inventory we have to add. When I'm talking about inventory, I'm talking about stock. So the inventory that we started with, we had the purchases we made in the year, we had the returns the customer made, the returns that we make to the to the supplier. We don't just talk about any expenses here in the gross profit. That's the difference between the gross profit and the net profit. So in the net profit, we are talking about the fact that there must be deduction of all expenses. That expenses has gone into the production, has been involved or incurred by the firm. So all the expenses that have been incurred by the firm in relation to the sales made, or in relation to whatever the activity of the business is, we have to do what? We have to deduct it. We have to deduct those expenses. That's what we establish by net profit. That okay, we thank God for us in the business. We have made 100 naira, but we have incurred a kind of expenses, 2 naira expense on the rent. We've incurred a kind of expenses, let's say 1 naira on electricity, and so on and so forth. We had all the expenses together and deduct it from our, from our sales. That is, sorry, from our gross profit. That's how we get our net profit. So let's go to the next thing. Okay, I've explained that we look at the trading profit and loss account as different from as one by one. Trading account is different from profit and loss account, but we call it trading profit and loss account. They are always together because one leads to another. I explain it as well that this account is used to determine the gross profit. The essence of trading profit and loss account, the essence of trading account is to determine profit. Is to determine profit. So what we do in trading account is to ascertain our profit, gross profit. And in ascertaining our gross profit, there are 6 things that are very important. Please, you must know them. What are the items in trading account? Opening stock, closing stock, purchases, sales, return inward, return outward, and carriage inward. And carriage inward. These are the things that are very, very important. Very, very important. In accounting, we talk about accrual method, accrual basis. Now, what is the accrual basis? Accrual basis is the fact that our income or expenditure should be what? Should be recognized in the period in which they relate, and not in the period cash receipt or payment is made for them. And by extension, whichever expenses that goes with that income or a liability incurred, we have to match it with one another. So what I'm saying in essence is that, let's say we make a sales of 10 naira. This 10 naira, there is a return of 2 naira. You understand? Our concept says, the margin concept says, margin concept says we have to deduct that 2 naira from our sales. You understand? And the correct concept is saying that even if you are going to deduct that 2 naira, it should be related to that sales, the period we have made it. You understand what I'm saying? So that is, you are going to learn more of those concepts in your accounting concept and convention. So I don't want to go into much details. Then return outward and carry that inward. All Everything about trading account is just relating to inventory, relating to sales, to purchases. Is There's nothing like expenses. There's nothing like expenses. I believe this is very, very clear. Then this account, we look at a profit and loss account. That one, when we're talking about P&L, our P&L account, we are talking about expenses. And by now, you should be able to, if I ask you, for example, that you should list 15 examples of 15 expenses that a business will incur, it shouldn't that should not be very difficult for you to do. You mention depreciation of assets, you mention wages, you mention wages and salary rather, electricity, rent, carriage out or discount allowed. You mention bad debt written off. You mention transportation, and so on and so forth. Similarly, if I ask you to explain some other income that accrue into the business, apart from the gross profits that will be brought down, you have your rent received, commission received, you understand, investment income. All these are part of the expense income that we realize from the business, that's in addition to our gross profit. So I'll try also to, we have explained uses of trading profit and loss account. I believe you can still remember. We said it is useful because it shows the business profit. Yes, it is useful for planning purposes. It is useful in computing the tax payable, how much tax the business will make, and we use it to compare our performance or performances. How much sales or how much profit did we make this year? We compare with the previous year and try to do a kind of evaluation of ourselves. So, what are the factors affecting profit? Very quickly, look at the selling price of the goods, the cost price of the goods, the number of competing firms, the relationship between demand and supply, the seller's knowledge of the market. See, after giving you a kind of simple calculation in regarding this topic, WAEC or NECO will just give you a small thing like this. They can ask you to list or explain any four uses of trading profit and loss account to a business person. Or they ask you to explain what are the factors affecting profit. Please, this is why you shouldn't just focus on the calculation. You also need this. The selling price of the goods will affect your profit. If you are selling low at a very small, if you are selling your selling price is low, then you won't make much profit, especially if people are not buying it. And if your cost price that you are buying your own goods, those things that you are selling again, if they are too much, it will affect your profit. Except you also are able to sell at a very high price. Then the number of firms that are selling what you are selling, you know what I mean by that are your competitors. The relationship between demand and supply will also explain that. If the demand is more than the supply, you as a business person, you have the grace to push it up, your price up, and make more money. But if the supply is the one that is in excess, it means that you are trying to beg the customers to buy. And when you are begging the customer to buy, will you increase price? You won't. In fact, you have to look for a way to beat down the price. Then the seller's knowledge of the market, you know, if this excuse me, if the sellers already know what the market price is, the quantity that goes for excuse me, that goes for each price, they are able to actually determine or influence our profit. So um I said I think this is where we stop that last class. So let's look at this illustration. Can you see WAEC August 1991? Go and check your past question. You will see a lot of questions there relating to this capital, relating to profit. So you are just going to be ahead if you are able to take it serious. So let's look at this question, the solution to this question, then we continue on profit again. Um, I just hope we can do another aspect of profit today. Okay, let's read together. The trading figures of ABC Ventures as at 31 this July 2010 are as follows. Can you see it? From the above, calculate the fixed asset, working capital, gross profit and net profit. It's still very closer to what we have done in our previous question on capital. But let's read it. Creditor is 20,000, premises 20,000, machinery 20,000, cash 20,000, okay, debtors 30,000, stock 50,000, cost of goods sold 100,000, sales 200,000, plant 30,000, then rent 10,000. So this question, I'm going to see, do I have the solution here? If I don't have the solution here, you are going to do it yourself. Okay, what is turnover? Okay, all right. I don't have the solution to this, but I'm giving you as a kind of assignment. Please go and do it. Let me change it. Illustration. Um, I'm not using illustration now. I'm calling it assignment. Assignment. Okay. Make sure you do it do it inside your book. Use your phone to snap it in form of attachment. You know, when you want to attach a file, attach it and send it to the Prodigy resource, to the inbox there. Let me see the solution, how you have done it. I believe you know you can identify your fixed asset. In fact, I like this question. So you just go through your last note, how we find the fixed asset, how we find the working capital. Then your gross profit and net profit. Now, you will definitely see how we're going to calculate that. You will definitely see it, how we're going to calculate that. And you have WAEC August 1991. I know you're smart. Some of you will just go through your past question and dump it. If you do that, you're not helping yourself. Okay? You're not helping yourself. All right, turnover. When we talk about turnover in business, what we are saying is the total net sales. Total net sales is what we mean by turnover. Total net sales. And what's your total net sales? That's your total sales. And when we're talking about total sales, your total sales can come from two different sources. It can come from credit, through credit, and through cash. But let's talk about everything now. Your sales minus your return inward is your turnover. Another thing we call it is net sales. We call it turnover or net sales. That is, you remove your, you remove return inward from your sales, we have net sales, or we call it turnover. And the rate of turnover is the number of times the value of average stock of a business is sold during a period. Now, it is used to ascertain the market success of a firm's output. Rate of turnover varies from product to product. Expensive products have low rate of turnover, while inexpensive and perishable goods have high rate of turnover. Now, when we talk about rate of turnover in business, this is the rate at which the stock is turned over. When we say stock is turned over, the number of times that our stock is being replenished, that our inventory is being replenished within a period. If you're in a production department, we realize that some goods are things that we buy often and often. For example, let's say we are into bread production. You know, definitely items like stock like flour, sugar, which other one? Yeast, nylon, those ones, their rate of turnover will be very high because these are the items that we use for production. And the higher the more the production we make, the more of those stock we have to buy. You understand? So in a store, that is where we measure the turnover as a rate of turnover. Even in business, okay, let's say how much sales have we made, or how many times our stock are we replenishing the store? How many times are we replenishing the store during the period or for a particular period? We look at that rate, and it's always rate of turnover. Okay, so How do we calculate rate of turnover? You have cost of goods sold over average stock. Where your average stock? What's your average stock? Your average stock is opening stock plus closing stock. Okay, then divided by, when we talk about average, opening stock plus closing stock divided by 2, please. Divided by 2. That's your average stock. Average is 2. When we talk about average of something is 2, please. This is average stock here. Opening stock plus, let me see how to correct it. Opening stock plus closing stock is over divided by 2. You will please correct it, and let's go on. You will definitely see how we solve this solution. So please, okay, let's look at this question. A large-scale retailer had the following balances in its book as at 31st December 1998. So look at it. It has this question, okay? Stock as at 1st January 1998. That is what we call opening stock, 15,750. Purchases is 85,000. Sales is 140,000. Stock as at 31st December 1998 is 7,000. 7,000. Return inwards, 20,000. Selling expenses, 10,000. Wow. So from the above, calculate the following. You have to calculate your cost of goods sold, your net profit, your rate of stock turnover. Rate of stock turnover. So let's look at it. Okay, let's look at the solution. Now, see the simple way I've tried to present the information. I have my sales. How much? 140,000. Okay, 140,000. Then I did what? Let's return inward. The return inward relates to sales, 20,000. Can you see it? If it is return outward, it will relate to purchases. You understand? So it will not relate to sales. Let's go on. So we remove 20,000 our return inward from our sales. That gives us 120. And this 120 is what we call net sales. All right. Let's move ahead. We look at the opening stock now. 15,750. 15,750. So as our opening stock, we had our purchases with it, add purchases to opening stock. That will be 5,000 naira, correct? Okay. Then the two together will give us 100,750. 100,750. What we have now is called cost of goods available for sale. Cost of goods available for sale. That's why I have to bold it. So in a question, if they ask you to find cost of goods available for sales, your opening stock plus your purchases plus your carriage inward, you understand? You had the three together, then you less your return outward. That will give you your cost of goods available for sales. Obviously, your return outward should have even been deducted from your purchases. You get what I'm saying? So you get your cost of goods available for sale. Now, by the time you minus your closing stock, how much is our closing stock? We have 7,000. Can you see stock as at 31st December 1998, 7,000. It's different from stock as at 1st January. This is the beginning of the year, and this is the ending of the accounting year, 7,000. So we deduct it from our cost of goods available for sales. What do we have? We have 93,750, which is our cost of goods sold. Please, your cost of goods sold is not the same thing with your cost of goods available for sale. You have learned that in your JSS1. In your JSS3. I know you have learned that. Even your SS1, you must have come across it. So when you are now in grade 11, your SS2, I don't expect you to be mixing things up. Your cost of goods available for sales is just what you get after adding your opening stock purchases, your carriage inward, you less your return outward. You will not less your closing stock yet. So if you have the figure you have before you remove your closing stock, you understand that one is called cost of goods available for sale. And if you have removed your closing stock, it becomes your cost of goods sold. So that's 93,750 here. Now, you see where I put it? I have my net sales here. So my net sales, if I remove my 93,750 from my net sales, that will be 26,250. Please confirm. Please try to confirm it. Let me reconfirm it with my calculator also here. All right. Please take your calculator and confirm it. 120,000 minus 93,000, 750. Good. 26,250 is what I have again. So look at it. That becomes my gross profit. So my gross profit now is the excess of my net sales over my cost of goods sold. Excess. That is what makes it more than the cost of goods sold. So we have 26,250. Then we talk about our expenses now. Let's talk about expenses. What is the expense that we have? Only sales. Selling expense is 10,000. So what do? We come to this place and remove it. So by the time we remove it from uh, our um, our gross profit made for the period, we have 16,250, which is our net profit. Very simple. There is no adjustment. There is nothing like no adjustment here. So I don't expect you to have any issue. So let's now answer the question. We have to find our cost of goods sold, which we have found in when we present it. Net profit, we have found it. Rate of stock turnover. So in summary, cost of goods sold is 93,750. Yeah, correct. Then net profit is 16,250. Can you see it? It's also correct. Then how do we find our rate of stock turnover? Our rate of stock turnover, okay, is our cost of goods sold over average stock. Cost of goods sold over average stock. Now, what's our cost of goods sold? 93,750. Abi? See it? Then average stock. How do we get our average stock? Now, your opening stock, let's see. Your opening stock is 15,750. Then your closing stock plus your closing stock, 7,000. So we sum the two together, then we divide it by 2. Definitely um it should give you 11,375. When you do the two, 15,750 plus 7,000 divided by 2. So it should give you what? It should give you your 11,375. So when it gives you 11,375, what you do now is to divide it. 93,750 divided by 11,375. 11,375. Please confirm it. You should have 8.24. You should have what? 8.24. Okay? 8.24. Now, that is that. 8.24 said ratio 1. Okay? That is how it is. So it's a very simple something. Okay, rate of turnover. That is that. 8.24 ratio 1. That is how we do it. So please confirm it. Very simple. That's how to get your rate of stock turnover. So that takes us to the end of that aspect. So let's look at another aspect of profit before we end the class. Okay. Um, that is profit continue. Turnover. Okay, we still have it here. I've explained it. Your sales minus return inward. The rate of okay. Can you see now that this one is correct? Rate of turnover. The previous one there, please try to correct it. Opening stock plus closing stock divided by 2. Okay, that is that. Then illustration. Do I have the solution to this? Okay, okay. There is no solution to it. All these things you have it in your resource. Make sure you do it. Please let me. Cost of goods sold, net profit, rate of stock turnover, and your turnover. I will make this one also to be assignment 2. Assignment 2. I'm not going to spoon feed you and do everything. Oh, sorry. Make sure you do it. Sorry. Okay, thank you. I'm trying to help you, to groom you. Okay, other important aspect of ratios. Net profit as a percentage of turnover. How do we get that? If you ask you what is the net profit as percentage of turnover, that's just a net profit over your turnover. You know what your turnover is. Your net sales times 100. Gross profit as the percentage of turnover. That's your gross profit over turnover times 100. Net profit as a percentage of sales and net profit percentage. Net profit over sales times 100. Your gross profit as a percentage of sales or gross profit percentage. That will be gross profit over your sales. See the difference oh. As a percentage of turnover is different from as a percentage of sales. Then expenses as a percentage of turnover or expenses over turnover times 100. Then your margin, gross profit over selling price, and the gross profit, your markup is gross profit over cost price times 100. Please, we use these ratios a lot. In fact, you have a topic in it in accounting, ratios, at least elementary for your level. If by the time finish your secondary school and go into you further your studies, you come across ratios. Whether you are doing accounting, you are doing business admin, you are doing name any course you are doing, you come across ratios because we use it for appraisal of business. We use it for appraising business. So it's always you always come across it. Factors affecting turnover. What are the factors that will affect our turnover, our sales or net sales? Number one, the price of the goods. A high price may lead to low turnover, yes. While a low price may lead to high turnover. It's possible in some sense. You understand? When the price is high, people may not buy. A rational person will not buy. Yes. But when the price is low, at least they will buy. They will patronize it. But not, there are some exemptions to that, especially when we are talking of looking at economist perspective. But forget your economist now. Price of the goods will affect the sales you make. Two, the goodwill and reputation of the seller. If the seller has a name or is someone that people know or the kind of good name they have, the goodwill, people may buy from them. But if they don't have that goodwill, it's possible that their sales will be very low. The nature of the goods, that is, whether essential or non-essential goods. Is it essential? Is it non-essential? Essential items are like food, clothing, and all that. But when we talk about non-essential goods, these are those things that you are just buying. Is it that you buy it to show off? It's not that you cannot afford the one that is very cheaper, for example, or something that you like cars. Cars are essential in some sense, but when it becomes too expensive, when you can just buy little one that you can just buy the one that will not be so expensive. Then advertising, publicity, and sales promotion. If people are aware, publicity, you make publicity and sales promotion, you give gift. You try, people want to buy things when you are giving them gift or you are reducing the price. You have more customer. The nearness of the sales outlets to customers. Very where you're selling is closer to the customer, they will buy. Availability of credit facilities. You are giving them credit facilities, they will always want to buy from you. It's not just I must only sell on cash. No. Then the proportion of slow moving goods in the total stock. If the slow moving goods constitute a large proportion of the stock, turnover will be low, yes. If goods that you have in your store, they are the ones that are not moving, they are the ones that you hardly use them, they will constitute what will affect your turnover. Then you look at this illustration, classwork, this is 10 marks, assignment, okay? So making another, okay, this is the third one, another classwork, 10 marks, you do it, making 3, okay? So making 3 exercise. You do it, it's very simple something you will do, just do it in your note and make sure you try and snap it, send it into the Prodigy resources, please, for your own good oh. Then you have another one here. The following was extracted from the books of Lem, the working capital, the rate of turnover. This is also very, very simple, but you can make this as assignment 4. You say, Mr. Wood, do you want to kill us? I'm not killing you. I'm trying to groom you. So the percentage of net profit on capital. So Maybe some other time we have we can okay this assignment 4 I will try and I will make sure we do it when next we have time. But that other ones I want to see your solution. But this particular one, okay, let me leave you. Let me leave you. Don't let me hard it for you. I will look for the time that we are going to do it. And if peradventure I didn't do it, try as much as possible to do it for your good. Oh, it can come out in your exam. So my dear student, this is where we're going to draw the curtain. Okay, illustration. Use the information below to answer the question that follows. XYZ Limited is trading company. The following transaction took place in the month of February. Purchase of goods is 32 suitcases at 3,500. This one is very simple. In fact, it's another question. You are required to calculate the gross profit, net profit, okay, gross profit percentage, net profit percentage as percentage of turnover. Let's see. In the next class, we can go through it before we do the topic we have. But make sure if you don't still go through it, you are going to do it yourself. But it's very simple. It's very, very simple. Okay, so this is where we're going to draw the curtain for today's class. See you again by God's grace in our next class. Thank you.